Analysis. Hey there, if you've ever looked at financial statements and wondered what the numbers really mean, today we're going to break down how to analyze them so you can actually understand the financial health of a business. We'll cover financial ratios, horizontal analysis, and common size analysis, all of which help turn raw financial data into useful insights. First up, financial ratios. These are simple calculations that help compare different parts of a business's financial performance. The three main categories are profitability, liquidity, and efficiency. Profitability ratios tell us how well a business is generating profit. One of the most common is the net profit margin, which is net profit divided by revenue. If a business makes $100,000 in revenue and its net profit is $10,000, then its net profit margin is 10%, meaning for every dollar in sales the company keeps 10 cents as profit. Liquidity ratios show whether a business can pay its short-term debts. The current ratio is current assets divided by current liabilities. If a business has $50,000 in current assets like cash and accounts receivable and $30,000 in current liabilities like short-term loans and supplier payments, then the current ratio is 1.67, which means the business has enough assets to cover its short-term debts. Efficiency ratios show how well a company uses its assets. One example is inventory turnover, which is cost of goods sold divided by average inventory. If a business has $200,000 in cost of goods sold and an average inventory of $50,000, then the inventory turnover ratio is 4, meaning the company sells and replaces its inventory 4 times a year. Next, let's talk about horizontal analysis. This looks at financial statements over multiple periods to see trends in growth or decline. For example, if a company's revenue was $500,000 last year and $600,000 this year, we calculate the percentage change as current year minus previous year divided by previous year. 600,000 minus 500,000 equals 100,000 divided by 500,000 gives us 20%, meaning revenue grew by 20%. Can do the same for expenses, net profit, assets, or liabilities to see if the business is improving or facing potential problems. Finally, let's look at common size analysis, which helps compare companies of different sizes by expressing everything as a percentage of revenue. On a common size profit and loss statement, revenue is always 100% and each expense is shown as a percentage of revenue. For example, if revenue is $500,000 and rent expense is $50,000, then rent is 10% of revenue. On a common size balance sheet, total assets are always 100% and each asset, liability, and equity item is shown as a percentage of total assets. This makes it easy to compare businesses even if one is much larger than the other. So, quick recap. Financial ratios help measure profitability, liquidity, and efficiency. Horizontal analysis compares financial statements over time to identify trends. Common size analysis expresses financial statements as percentages to make comparisons easier. Understanding these methods helps businesses and investors make smarter decisions. If this made sense to you, stick around for more.